Happy Monday, everybody. Howdy. I am Raymond Dahlman, your humble host here at the Liberty Call. And it is, like I said, Monday, December 23rd, 2024. Hope you're having a fantastical day. Hope you had a great weekend. It's been kind of gray and overcast the last 2 days. Not as bad today, but yesterday was all gray. There was no sun. Just kind of makes you malaise. But anyways, it is Christmas week. We got today, tomorrow's Christmas Eve, Wednesday's Christmas. Then we got Thursday and Friday. So I think there's some short market days, probably tomorrow. And obviously the market will be closed Wednesday. So I may or may not be doing videos every day of the week. Definitely today because I'm on right now. And definitely I'll wrap up the week on Friday. So, but I will be in and around the office. So if anyone out there needs something from me, call, email, whatever, get in touch with me if you need, some money sent out or you need something done or whatever, just let me know. So, all right. Well, before we jump into the markets for today, if you could do me a favor, give me some thumbs up, a like, share, subscribe, follow, and press the notification bell. All righty. Let's hop in. Dow Jones was up 0.16%, 66 points, closed at 42,906. S&P 500 up 0.71%, 42 points. Closed at 59.72. NASDAQ up 0.95% today. It was at 184 points. Closed at 19,757. The VIX was down 7.63% today. It's at 16,996 right now. Canada was up 0.61%. Brazil down 0.96%. And Mexico down 0.29%. Over in Europe, Germany was down 0.23. The UK was up 0.22. France down 0.03. The Netherlands down 0.37. Spain down 0.28. Italy down 0.08. Switzerland up 0.85. And Portugal up 0.46. Russian exchanges both green today. The MOEX up 2.45%. RTSI up 3.19. Leads me to believe oil's probably doing well today. Let's see here in the overnight markets. The Nikkei was up 1.16%. Australia up 1.67%. New Zealand up 1.28%. In China, the Shanghai was down 0.5%. The Shenzhen component down 1.03%. China A50 up 0.95%. DJ Shanghai down 0.69%. Hang Seng up 0.82%. And the Taiwan weighted up 2.64%. All right. Good stuff. All righty. Well, let's hop into our weekly economic update. Stocks were under pressure last week as Fed chair's hawkish comments unsettled investors ahead of the holiday season. The Dow Jones Industrial Average received the hardest hit, falling 2.25%. The S&P 500 lost 1.98%, while the NASDAQ dropped 1.78%. Overseas markets retreated an eye-catching 3.38%. No Santa yet. Divergence marked the start of the week as mega caps tech stocks rallied while the Dow Industrials fell for the eighth straight session, its longest losing streak since 2018. Following its scheduled December meeting, the Fed announced it was cutting short-term rates by 0.25 point, as widely expected. However, Fed Chair Jerome Powell also signaled fewer rate reductions next year. Quote, "From here, it's a new phase, and we're going to be cautious about further cuts," end quote, he said in his post-meeting news conference. The rate news surprised investors who were anticipating more dovish comments from the Fed chair. Markets were under pressure again early Friday as the spending bill to fund the federal government appeared to stall, but a lower than expected inflation update boosted the market and helped erase some of the earlier losses. All right. Holiday cheer. Despite a difficult week, stocks are on track to have their second consecutive year of double-digit returns. Year to date, through Friday's close, the S&P 500 was ahead by about 24%. In 2023, the S&P 500 tacked on 24% for the full year. Key economic data this week: Monday, consumer confidence; Tuesday, durable goods and new home sales; Wednesday, stock markets closed; Thursday, weekly jobless claims in the Fed balance sheet; and Friday, international trade in goods. And no companies reporting earnings this week. All right, that's a first. All righty, well, let's get into the market recap. S&P 500 rises as tech shines in holiday shortened week. The S&P 500 rose Monday as tech made a strong start to the holiday shortened week. The New York Stock Exchange is set to close early Tuesday for Christmas Eve, and the market is shut on Christmas Day. Tech rally in chips higher. Tech led the broader Tech led the broader higher, underpinned by rally in chips with Broadcom, NVIDIA, and Qualcomm. Broadcom Inc. added 4% to its recent more than 40% surge it's seen so far this month as investors continue to snap up shares of the chipmaker following its bullish quarterly results and guidance released earlier in the month. Qualcomm stock rose 3% after a jury found its central processors are properly licensed under an agreement with UK-based ARM Holdings, which fell over 3%. Fed interest rate moves are key. PCE price index data, a key inflation gauge favored by the Federal Reserve, rose 0.1% in November, a slower pace from October's 0.2% increase. This brought the annual PCE inflation rate to 2.4%, slightly below estimates of 2.5%. Although the recent data indicated some cooling in inflation, it still remained above the Fed's 2% annual target, indicating that overall inflation still remains sticky. The Fed signaled a cautious approach to monetary policy adjustments, emphasizing the need for continued progress on inflation before considering further rate cuts. Comments from Fed officials on Friday showed that some policymakers were starting to factor in fiscal policy uncertainty, such as tariffs, in their outlook. Fed officials reiterated they were still uncertain about how the new Donald Trump administration policies would affect interest rate outlook, with some saying it was the very same uncertainty that led to them to forecast fewer cuts in 2025. The Fed cut rates 25 basis points on Wednesday, but forecast just 2 rate cuts next year compared to prior forecast of 4 cuts. Let's see here. Also, in other news, Rumble stocks jumped 89% after the video sharing platform said it received a strategic investment of $775 million from cryptocurrency firm Tether. And Eli Lilly's stock gained 3% after the Food and Drug Administration approved the drug maker's weight loss treatment, Zepbound, for obstructive sleep apnea on Friday. All right, and that's all the market news for today. So let's dive into some data. The November durable goods orders, or November durable goods. This comes to us via First Trust and Mr. Andrew Opdyke. So let's see what news is there. New orders for durable goods fell 5.2% over the past year, declining for the third time in 4 months in November. Transportation orders were primarily driven, were the primary driver of the decline, with commercial aircraft orders dropping 7% and defense aircraft orders falling 2.6% following sharp increases in October. Excluding transportation, orders fell a more modest 0.1%, with declines in fabricated metal products, negative 1.6%, and computer/electronic products, negative 0.7%, offset by gains in machinery, a positive 1%, primary metals, a positive 0.7%, and electrical equipment, a plus 0.4%. A bright spot in the report were core shipments, a critical measure for business investment and GDP calculations. Core shipments rose 0.5% in November after a 0.4% gain in October, potentially signaling a 2.5% annualized growth rate in Q4 if trends hold steady in December. This would mark a return to positive movement after declines in the second and third quarters. Despite these gains, durable goods orders overall have not kept pace with inflation over the past year as the Trump administration returns to Washington with plans to cut taxes, reduce regulations, and shrink government. Businesses face uncertainty about the policy environment and its implications for investment. Meanwhile, the Federal Reserve continues to navigate the lagged effects of prior monetary tightening and the lingering impacts of COVID-era stimulus measures. Volatility in economic data is expected in the coming months as these factors evolve. Good stuff. All right. Well, next up, a little more data. November new home sales. This is also from First Trust. Mr. Bryce Gill put this report together. New home sales rebounded 5.9% in November, recovering from hurricane-related delays in the prior month. However, pace remains comparable to 2019 levels, reflecting a housing market still struggling to gain momentum. A critical question is whether the Federal Reserve's recent rate cuts can spur a sustained upward trend in sales. So far, the anticipated boost from improved affordability has not materialized, as 30-year fixed mortgage rates have risen above 7% since September, keeping many buyers hesitant. The median sales price of new homes dropped 6.3% over the past year, partly due to a decline in price per square foot, which fell 1.1% from 2022 to 23. This marks a stark contrast to the 45% increase seen from 2019 to 2022. Additionally, developers are increasingly offering smaller, lower-priced homes, further contributing to the decline in median prices. Inventory has played a significant role in pressuring prices. The supply of completed single-family homes is up nearly 300% from 2022 lows and now sits at the highest level since 2009. This contrasts with the existing home market, which continues to face inventory challenges as homeowners hold on to low fixed-rate mortgages obtained during the pandemic. While financing costs remain a concern, lower prices and increased inventory are providing buyers with more options, which could eventually lead to a stronger rebound in new home sales. Still waiting, people, thinking that lowering rates, a total of now at 1% is going to make some huge, massive difference in the mortgage business. But I mean, you can't push rates down or hold them at zero for, basically Obama's entire term. They start to creep up a little bit during Trump's term. And then we hit some financial pitfalls along the way in late 2019, going into 2020. And then, we know what happened in 2020. The whole COVID nightmare happened and gave an excuse to print a bunch of money and, make everyone think that there was nothing wrong with the economy when there were some serious problems at the time. And now we're just going to have to deal with those issues, 4 years later. So, all right, last up, excuse me. This comes from Zero Hedge, titled the title is Elon Musk, quote, the Fed is absurdly overstaffed, end quote. A government agency overstaffed. I know, it's hard to believe. All right. The Ron Paul revolution could gain traction as President-elect Donald Trump prepares to take office with plans to streamline federal operations through the newly created Department of Government Efficiency, DOGE. Elon Musk, a key advisor and DOGE leader, recently criticized the Federal Reserve as absurdly overstaffed and emphasized the need for significant reform. The Federal Reserve employs approximately 23,000 people across the Board of Governors and 12 regional banks. That is a lot of people. With salaries and pension costs reportedly reaching $7 billion, equivalent to $304,000 per employee. Shocking, I know. Critics argue this level of expenditure is excessive, particularly given the Fed's recent financial losses and missteps, such as its failure to predict inflation stemming from a rapid expansion of the money supply, which is dismissed as, quote, transitory. Remember Janet Yellen saying that back in May of 22? DOGE, co-led by Musk and Vivek Ramaswamy, aims to cut $2 trillion in federal spending and create a leaner, more efficient government. Musk has expressed interest in bringing Ron Paul into DOGE, citing his alignment with the goal of reducing the Federal Reserve's influence and size. Paul recently advocated for weaning the U.S. off the Fed, a sentiment Musk enthusiastically endorsed. The initiative comes amid growing scrutiny of the Fed's bloated workforce and operational efficiencies. Critics point to its inability to forecast major economic trends, raising questions about the effectiveness of its 400 PhD economists. Musk's comments and the DOGE's plans signal a potential shakeup in how the Fed operates with a focus on automation, advanced technologies, and cost-saving measures. Fed Chair Jay Powell's position may also face new challenges under the incoming administration. Yeah, 400 PhD economists. Well, here's my thing, since most of them are probably going to be without a job here in the upcoming months. If any of these folks want to go out and be financial planners, I probably wouldn't use them because these people are just dumb as crap. And me, without a college degree and just has done a lot of reading over the last decade, and especially centering around Austrian economics, people like Rothbard, Mises. Granted, I am no expert. I am a student of economics at this point in my life. I don't have enough gray hair to maybe when I'm 70, but I mean, I'm only 50 right now. I'm still a young kid. Yeah, these people are idiots, and all they do is waste our money. I mean, at the time I said, printing all this money is going to create a massive inflationary bubble. I was right. They were wrong. So, all right. Well, that's everything that I had to cover for today. I mean, I could sit here and probably bitch and moan for another 20 minutes, but I'll let everyone get back to their day. So if anyone needs anything from me, please go to DSAFinancialGroup.com. All your financial planning needs can be addressed there. So feel free to give me a call. I'd be happy to help get you on track towards becoming a bazillionaire. So, all right. Like I said, that's everything I had to cover for today. Go to the website if you need me. Otherwise, have a great evening, and I'll do a video definitely by the end of the week. I might do one tomorrow. I don't know. Just depends on how I feel. So hope you have a great night. Talk to you later. Adios.